On April 2nd, Donald Trump announced tariffs on more than 100 countries around the world. These range from 10% on the UK to 20% on the European Union to as high as 49% on some other countries. Now, immediately, many economists predicted a high chance of a recession in America and other countries. S&P 500 futures fell 3% right after the announcement. But the real question European investors are asking is this: will Trump's tariffs cause a major stock market crash? I started my career on Wall Street during the great financial crisis when the market fell by as much as 50%. Over my 17 years in finance, including my time as CEO of a European investment company, I've seen several market crashes. In this video, I will explain why Trump's tariffs are such a big deal, the unexpected effects this could have on the stock market, and why one of the most popular strategies European investors are using right now could be a mistake. Okay, so first, are tariffs actually such a big problem for the global economy? Well, think of it like this. Meet Farmer Bob. He's got a wonderful farm with all the best conditions for raising chickens. In fact, he raises so many chickens he can't eat all the eggs, so he sells some of those eggs to his neighbor, Anna. Now, Anna also has a wonderful but very different farm with the best soil possible for growing carrots. In fact, she grows so many carrots she can't eat them all, so she sells the extra carrots to Bob. Now, in this free trade situation, both sides benefit. But Bob's farm is actually owned by his uncle, Donald. Uncle Donald notices that a lot of money seems to be leaving Bob's farm and going to Anna, and he doesn't like that. So he announces a tariff. For every $10 box of carrots that Anna sells to Bob, Anna will have to pay an extra dollar to Uncle Donald. Now, what happens next? Well, for Anna, her income per box of carrots goes from $10 to $9, so she raises the price of carrots from $10 to $11 to compensate. Now, Bob either has to spend more to get the same amount of carrots, or he has to buy fewer carrots. In any case, he is worse off. If the tariff is big enough, sure, Bob might even be motivated to start growing carrots of his own. But the problem is, the soil on his farm is not as good as on Anna's. So this will end up costing him more anyway. And what about Anna? Well, demand for her carrots is falling, her income is falling, and she is worse off as well. As it happens, Anna's farm is actually owned by her auntie, Ursula. Auntie Ursula doesn't like this tariff situation with Uncle Donald, so she says, well, we're going to have a tariff as well. Every time you sell us $10 worth of eggs, you will have to pay $1 extra. So now Bob has to raise the price of eggs, and this makes eggs more expensive for Anna. And she has to reduce her consumption and maybe start raising chickens of her own. And of course, this also hurts Bob because his income is falling. And suddenly, these friendly neighbors who used to get along and really benefit from each other find themselves in this fight where everything is getting more expensive, they can afford to buy less and less, and they are forced to spend their time and energy doing things that they are not really suited for. Now, obviously, this is a big simplification, but that is tariffs in a nutshell. So when Donald Trump puts tariffs on imports from partners like Europe, that forces importers to raise their prices, which makes imported goods and services more expensive for American businesses and consumers. And while it can lead to increased domestic production of some goods and services, this usually ends up being more expensive compared to importing. So the US economy is likely to suffer. For example, in 2002, US President Bush put tariffs on steel imports to protect steel production in America. But according to some estimates, this actually caused American job losses of 200,000 people in industries affected by rising prices. And importantly, at that time, the US steel industry employed only 187,000 people. So this is just one example of how Trump's tariffs are likely to hurt the American economy. And of course, on the trade partner side, their exports to America will fall, so their economies are also likely to suffer. So this is why many economists fear that this trade war could lead to recessions in the US and in other parts of the world. The closest analogy to what's happening today is perhaps the Smoot-Hawley Act that America passed in 1930, and this was at the start of the Great Depression. This act put tariffs on tens of thousands of imported products. According to The Economist, This made global trade fall by 2/3, dramatically, okay? And it was so catastrophic for growth in America and around the world that legislators have not touched the issue since. Smoot-Hawley became synonymous with disastrous policymaking. Now, to be clear, I'm not saying tariffs are always a bad idea. There are geopolitical reasons why certain tariffs can be necessary. For example, imagine that a country buys 100% of its food from abroad because it's cheaper that way. Well, that is great while times are good, but if a war breaks out and those foreign countries don't want to sell you food, well, you're in a really bad position. So it can make sense to have some tariffs in place to protect domestic production, even if economically it's not optimal. That said, the kind of sweeping tariffs that Trump has announced are hard to justify by this standard. So, does that mean that the stock market is going to have a major crash? Well, to understand this, you have to understand how stocks are priced. When an investor buys shares in a company, they pay a price based on what they expect the future profits and the future dividends of the company to be. In light of the tariffs, investors will likely expect lower profits in the next few years, so that can naturally lead to some correction in stock prices, and we are already seeing that. But to have a sustained major crash, okay, so for the stock market to drop 30 or 40 or 50% and stay down for a while, investors have to become convinced that company profits will be decreased significantly and long term. For example, if the US economy really starts hurting, the American Congress has significant ability to stop tariffs even against Trump's wishes. If they don't do it, next year they have midterm elections. And in 3.5 years, there's another presidential election. And historically, when the economy is doing bad, presidents tend to get replaced. So even if stock prices start falling because some investors are scared, others are likely to say, well, let's not overreact. Sure, we will have some pain for a few years, but it's probably not the end of the world. So these optimistic investors would use the opportunity to buy stocks at lower prices. And this could stop or reverse any crash. So if scenario 1 is a big, prolonged stock market crash, scenario 2 is that we could see something like the short-lived COVID crash of March 2020. I was an investment company CEO when the pandemic broke out and everybody was panicking and the stock market crashed. At our company, we just kept calm and kept investing. And that turned out to be a great strategy because within weeks, investors decided COVID wasn't so bad after all, and the market shot back up. But the people who sold in a panic lost their money. Something similar could happen with this tariff situation. Or you could have scenario 3, where the market has a small correction of 10 or 15% and then keeps going. Or a fourth scenario would be that the markets just keep on growing, but simply at a slower pace than before. And then, of course, there's always the possibility that we are wrong about the impact of the tariffs and that Trump's economic team are geniuses and that things will go amazingly well. I wouldn't count on it, but I can't rule it out, so that would be scenario 5. As you can see, there are many possible outcomes, and if you feel certain about which one will happen, well, you may want to think again. That would be a form of market timing, and this is notoriously difficult. There's a reason Nobel Prize winner Robert C. Merton called market timing a fool's errand. Remember what Warren Buffett said, the only value of stock forecasters is to make fortune tellers look good. The stock market is an extremely complex system. Long term, it's always been unstoppable, but in the short term, it can be wildly unpredictable. And this leads me to the one strategy that I see many European investors adopting, which could be an expensive mistake. Whenever things get scary, a lot of people say, well, I'm just going to take my money out and wait for things to calm down before I start investing. And in some scenarios, like a market crash that is prolonged, that stays around for many years, this can turn out to be a good idea. But in most cases, it ends up being a losing strategy. People who try to time the market get into trouble because sometimes they have to wait for years for the anticipated crash to actually come. And then when the market does start crashing, it is really hard to decide when to invest because you're always thinking, well, what if prices keep going down? It is just so very difficult, and trust me, I speak from experience. Back in 2009, the market was down 50%, and I was thinking about investing. But I was too scared because it was the middle of the financial crisis, and many of my professional investor colleagues on Wall Street were terrified. So I missed an amazing opportunity to invest at low stock prices. And in fact, it was years before I started investing in a serious way. And by that time, stocks were much more expensive. There's a huge amount of research that shows time in the market beats timing the market. If you just stay invested and keep investing over the long term, you're much likely to do better. Now, of course, you want to take some precautions. You want to make sure you have a safety cushion sitting in the bank. You want to make sure you are diversified so you're not investing in just one country, one region, one industry. But over the long term, the proven strategy is to stay invested. Now, timing the market can work out once or twice over your lifetime, but if you do it enough, you will lose. Now, the good news is market crashes are not nearly as dangerous for investors as you might imagine. Back in 2014, Ben Carlson published a wonderful article about Bob, the world's worst market timer. This is a different Bob than from our farming example. Market timer Bob had the worst possible luck. He only invested his money right before major stock market crashes in 1972, in 1987, in 1999, and in 2007. In total, he invested $184,000 over 40 years. And he invested all of this money at really bad times. How did he do? Well, by 2014, Bob was a millionaire. His account value was $1.1 million. So whenever I start to worry about market crashes, I remember about Bob, the world's worst market timer. If I don't invest because I'm scared of crashes, I will make no money. I will stay poor. If I try to time the market, I'm likely to make expensive mistakes like Bob. But if I stick to my system and just keep investing, then sure, the market will go up and it will go down, and sometimes I will experience big losses. But long term, I'm very likely to get a better result than Bob, and he ended up a millionaire. Now, it is difficult sometimes to stay calm when there are dramatic news and the markets are bouncing up and down. To help European investors succeed, I have a free newsletter with over 70,000 readers all over Europe. In this newsletter, I share investing insights, money tips, and my views on what's happening in the market. If that sounds valuable, follow the link in the description to sign up.